Hi, most of our users work in big tech. When it comes to financial planning, three challenges come up again and again: managing RSUs, dealing with concentrated stock positions, and optimizing for taxes. To handle this effectively, you need a clear picture of your financial goals and solid projections for your income, taxes, and investments. That's the foundation for making smart, tax-efficient decisions. Today, I will show you how to make these projections more flexible for what-if analysis. We just introduced a new feature called Milestones. With the Milestones, you can set start and end dates for any income and expense. When you adjust the milestone, all related income and expenses automatically update, keeping everything in sync. That makes your projections more accurate and prevents mismatches where one of the events changes, but others don't. It's a simple way to keep your plan realistic and responsive to life changes. Today we are building a projection for a family living in California. They're in their late 40s and they would like to update their projection. They already have something built and they have living expenses separated for each stage of their retirement. When it comes to the retirement, normally there are a few stages of phases. It all starts with early retirement, or call it go-go years, when expenses go normally up and people start travel, have different experiences, and their expenses are higher. Then mid-retirement is called normally slow-go years. That often begins in 70s, 80s, and this is where people start to reduce their living expenses. And the late retirement, which typically starts in mid-80s, is called no-go years. So in this projection, we already have these living expenses added for the family. And currently, the family wants to stop working in 2035, in January 2035. And their retirement is going to be these three stages. Go-go years from 2036 to 2045. Actually, I would like to replace that 1 year. Okay, click apply. Then slow-go years from 2046 to 2056, and no-go years after that. So let's go and right now these are calendar dates. So if I change anything, let's say in the income, and I specify 2038, which is later, I don't update automatically other expenses in the family, which may cause issues down the road. So what we are going to do is we are going to enter the projection settings, and we will create a few milestones. We'll call it retirement go years, and it will start in 2036. There are two criteria types. You can either use age criteria or date. You can specify, if you choose age, you can specify the family number and say this is when Steven will turn 60. That may work. You can click apply and you see that it will calculate the date when Steven turns 60. It's going to be in October 2036. Or we can change this to be date criteria and say this is going to be January 2036 and pick any date for that. Now the second one, we will add retirement slow-go years. That's going to be from 2036. And one more milestone to add is the retirement no-go years. That's going to be 2056. Click apply. All right, so we have our three events created. So now if we go back, we can start replacing these calendar dates by the milestones. So the end date for Steven is going to be not 2039 anymore. We click on the end date and we scroll all the way down and you see the list of milestones. And we select retirement go-go years, which we just created. Click apply and projection has been updated automatically. Now we will do the same thing for Sophia. So we'll select retirement go-go years. And it's going to be January 2036. Click apply because the family wants to retire at the same time. And now we will go and update their living expenses. So instead of the calendar date, we will say that it will start at retirement go-go years, and it will finish at retirement slow-go years. Click apply. For slow-go years, we will say that it will start at slow-go years and end at no-go years. Very simple. Click apply, and our projection is being updated. And for no-go years, we will tell that the start date is going to be no-go years, and it will go till the end of the plan. We are not finishing these expenses, and click apply. All right. So now, if we would like to adjust some of the things in our projection, and let's say Steven wants to see what will happen if they retire actually earlier, let's say 6 years earlier, they click apply, and projection has been already updated. We go back and we see that for the current set of expenses that the family has, they're going to run out of money. So if they want to retire earlier, they will need to adjust something. The sign that they are running out of money is that their net worth is going to the zero, and then it becomes negative over time. So that's not a good projection. So what we can do here is first we can change back retirement go years, maybe 2034, click apply, and maybe another thing that we can do is that we can reduce the go-go years, and we can say that it's not going to be from 2036 to 2046, but let's say go-go years for the family, they will be only for 5 years, starting till 2039. Click apply. And now, so the projection has improved, but still that tells us that they will run out of liquid assets at the moment. So they will need to probably liquidate their property in this case, assuming that things will go as planned. So they will need to continue working on these adjustments. But the advantage of using the milestones in this case is that they make sure that all income and expenses that they have, they are synchronized in this case. I hope that this video was useful. Please let me know if you have any questions, and talk to you later.